Good evening, everyone. Thanks for joining on a weekday evening as part of our series of webinars as part of this COVID situation. So, most of you already know me, but if you don't know, I'm Kishore, based out of Houston, Texas. And we organized over 200 plus webinars in last 2 plus years on various different concepts. I don't want to repeat because many of you might have joined my previous sessions. Just I want to give a quick update on what are the future webinars or immediate webinars. So tomorrow we have a webinar on a primer on college essays, right? Why college essays are important for kids' college education, right? What all high school students know need to know about essays. That is, we have that concept. Mr. Raj Kamal, one of the like experienced student counselor, he will be taking that session at 7 p.m. CST. Then on Friday we have mortgage and refinance concepts. Many of our group members are asking like, is it good to buy houses now, or do we need to refinance our homes? So I got a lot of requests. So one of the famous mortgage specialists from Dallas is going to take a session on uh, on Friday at 8 p.m. CST. Then take charge of your mind, Mr. Mohan Naidu, one of the experts in this field. He trained thousands of students and thousands of adults on meditation and lot more concepts. So the take charge of your mind session is on 4/19 9 a.m. CST. Don't miss this session because especially in the current situation, we all need to be away from all the negative thoughts. We all need to be positive. So this session will help each and everyone to be positive, to make sure we are not thinking, we are not feeling depressed, or we are not feeling anxious, all those things. Then I am also talking to few more experts on advanced concepts of Bitcoin, options trading, forex trading, and few more sessions I'm discussing with a few more subject matter experts. Again, if you have any topics in your mind, if you want to get more details on any of the other sessions, I can connect with the subject matter experts. You can text me or you can email me on your feedback of these sessions, and also if you need any other specific topics which you want. Right. Moving on to our guest speaker today, uh, Kavita ji. She's principal at Cherry Street Investments, an Austin-based real estate investor and a full-time multifamily sponsor with over 10 years of investing experience in single-family and multifamily real estate. Before real estate, she worked in IT profession for around 19 plus years for IBM and Atlassian. She is currently owning and managing her own rental portfolio in Austin, San Antonio, and also invested in over 2,200 plus doors units in San Antonio, DFW, Atlanta, and Phoenix MSA as a limited partner, and over 650 doors as a general partner and key principal. Besides being active investor herself, she is also very passionate about educating investors on various type of passive investments and helping them onto their journey towards financial freedom. She aims to educate her investors on multifamily, opportunity zones, and more through her purely passive investor group, Facebook group, and Cherry Street Investments YouTube channel. So she also shares a lot of common interests. And thanks, Kavita ji, for taking time. Uh,
Thank you for having me on, Kishore.
yeah. So it's all yours, Kavita ji.
Okay, thank you. I'll just share my screen.
Yeah. Yeah, we can see Kavita ji.
Oh, you could see
Oh,
my screen?
no, screen, no, no. We can only
Okay,
see your picture. Yeah.
okay. See.
Yeah.
Can you see now?
Yes, we can.
Perfect. Good evening, everyone. Thank you so much for being here. And thank you, Kishore, for having me on for this webinar today. First of all, I wanted to say I'm really impressed to see such a motivated and big group of people here. I know that you all have the right mindset and attitude given the circumstances. And I think that's really, really important because there's so much negativity around us right now that it's so easy to get pulled into it. And I strongly believe that learning and growing in this time period is really important. And I also do a lot of webinars just for that same reason, where I keep myself busy doing it, and I love educating people. And I also feel like it helps other people to be learning and growing at this time and being ready for opportunities when they do arise. Although there's not really much going on in terms of commercial real estate investments, buying right now because of all the situation that we are in. I do believe that there'll be opportunities for us, and I'll talk about that as well today in my webinar. Oops, I think I've paused my sharing. Sorry, I don't want to go over this. Thank you, for, Kishore. I didn't know if you're going to introduce me or what you're going to do. So anyway, I have it here. Just one note there. I retired myself from my IT job last year after working almost 19 years in technology. And this was thanks to real estate, because I started investing in the last downturn in 2009. And what I heard from a lot of people after, the things started coming back on, and it was like 2016, 17, the boom time, and people always said that, hey, I wish I'd started buying 10 years ago as well, or in the downturn. But what I did see was different, where people were not willing to buy because they didn't know what lay ahead, right? They didn't know the risks involved, or they didn't evaluate, but they weren't really ready to buy. But everybody looks 5 years behind and says wish they'd done it. So I just wanted to say that, because it's really important for us to look at this as an opportunity which will not come again. And I do believe that this probably will be worse than 2008, or at least just as bad. I spoke about this, and I want to briefly, I did a shorter presentation a few weeks ago, but I do want to talk about it briefly. So the reason I like this, and lots of you, I don't know how many of you have read the book Rich Dad Poor Dad by Robert Kiyosaki. That's what got me on this journey of creating passive income and trying to get off my employment, full-time employment. And this is something everybody should understand if they haven't already seen it. So I might be repeating it for some folks, so please bear with me. So the left side of the quadrant are the employee and the self-employed people, where you actually own a job or you work for someone and have a job. So the essential and the bigger problem on this side of the quadrant, or the two quarters of the quadrant, is that you end up paying really high taxes in both cases. So even if you do think you're self-employed and you have time, the minute you stop working, you don't make money. And what we want to do is all our goal should be to go to the right side of the quadrant, where we create passive income, where even when we're not working, the money still comes in. So there are two ways to create passive income. One is you're a business owner or you're an investor. So primarily what we're trying to do here is get more people on the investor side, where they are creating passive income without working for it, and it helps them reduce their taxes as well, having passive income. So in terms of passive investments, what is a passive investment? It's essentially a place where you put your money to work and you're not putting in any ongoing time or effort investments. So there are two types of passive investments. It could be a debt instrument or an equity instrument. In a debt instrument, it's kind of like a mortgage. A person, a lender who's lending you a 4% mortgage, they have a fixed upside. They're always going to get 4%. It doesn't matter if the market goes up 30%, they're still going to pay you 4%, or you're still going to pay them 4% if you are borrowing from them. There's low risk, that there's not much risk because there's not much upside as well. So there's no participation in equity. We do these kind of investments in passive real estate as well. So you can be a debtor versus be an equity investor. So there are both structures in passive real estate investing. The other option is equity investments, which most of you are familiar with stocks and passive real estate. In equity investments, there's both cash distribution and equity returns. A primary example is like a stock, dividend stock. So you have the dividends coming in, which are your cash distributions. And when you sell the stock, you might realize the equity or the investment. So similarly, passive real estate works similarly. We provide cash distributions, and then we have the equity returns on the sale of the property. So Before we head into the discussion of multifamily, I want to talk about single family versus multifamily investment. Normally, I ask how many people in a live room do single family investments, and I get quite a few hands up. So I'm sure there are a few people on here who have single family investments right now. So the question for you guys is, are single family rentals really passive? I've been a single family investor for 11 years now, and I can tell you that it's not been really passive. It takes up a lot of my time. Tenants take up a lot of my work work time, and managing them, managing issues with the property. And when you have one or two, it's still doable. When you start scaling up or trying to scale that up, and that's when you really feel the pain. And that's sort of what moved me to multifamily real estate from single family. Is when I started scaling up, I realized there was no way I wanted to deal with another tenant, another renter, another broken toilet, none of that stuff. So there's a lot of issues here. You have tenants, you have utilities, you have collections, you have complaints from tenants, you have no rent sometimes, and that's kind of what we're going through right now. That's not to say it doesn't happen in commercial, it can, but you're not dealing with it directly, right? You're completely hands off. So let's compare a typical single family versus multifamily investment. Again, if you had attended my short presentation a few weeks ago, you might have seen this. So I do want to repeat it for the folks who haven't been there the last time. So typically in a single family investment, when we say single family, it's anywhere from 1 to 5 units. Technically, when you look at all the lease application forms and the forms, it's 1 to 4. Over 5 units is considered commercial or multifamily investments. But typically for us to say it's a multifamily investment that we are syndicating and opening up for passive investors, we typically go 50 units and up. The reason for the number 50 is just the economies. When we scale up over a certain number of units, we achieve more economies of scale. And that's sort of where we lay. Let's say we go to a 20 unit, we don't really see as much benefit. It's a lot of work, and the returns are much lower for the same amount of work that we can put into a 50 unit and up property. But that said, let's say I'm buying a 50 unit up in Austin or in San Francisco, huge price difference, right? So generally when I say 50 unit up, it's also a dollar amount that makes sense, because we can employ a full-time person on board to do all the leasing at that point. Whereas if I go 50 units and up in Alabama or in Missouri or some other smaller place, I might not be able to employ a full-time person to lease the apartments. So that's typically 50 to 70 units generally in most places. Let's look at the cost. A lot of you who've done single family homes, bought single family homes to live in, know that the cost is based on comparables, like what they call comps. Whereas the value in multifamily is based on NOI, which is the net operating income, and what's called the cap rate of the market. And we'll talk about both of these factors a little bit more. The third factor is the scale. So when you're looking at, let's say you go buy a single family home in Austin, it's probably going to cost you about $300,000. That's the median home in Austin, where I am right now. And the per door cost in single family is much higher than multifamily investment, because let's say I buy 50 doors, I might pay 150 per door instead of 300 per door. So the per door cost comes down in multifamilies. Come to the management aspect. The property management typically costs about 8 or 10% in single family, whereas we typically pay between 3 and 4%. So you can see there's economies of scale in the management costs as well. We also have the rehab costs, because we're doing a rehab at a larger scale, sort of wholesale versus retail cost, right? So you're doing one door rehab, like a single family rehab, it might cost you, let's say $20,000. We do rehab, it costs us $5,000 per door or per unit. And it's usually called per door in multifamily world. The last one is tax savings. And we'll talk about this in more detail as well. The depreciation in single family investments, for those of you who own rental properties, you take the the property value minus the land value, and you depreciate it over 27 and a half years, and you take that depreciation every year. In multifamily, it's much higher, and it's called accelerated depreciation or bonus depreciation. And I'll talk about what that means to your investment. So let's say typically you have $100,000 investment, you're depreciating anywhere between $40,000 to $60,000 of that investment, which means you get a loss on your tax statement for that amount, 40 to 60,000. So let me pause here and ask if there are any questions. I don't know where the chat box is. Let me see.
Yeah, as of now, there are.
Okay. Okay, I'll keep going. So what is a syndication? This is some of the key terms you need to understand passive investments. A syndication is essentially an effective way for us to get a pool of investors together to pool their capital and buy larger properties than they would do as an individual investor. So as an individual investor, let's say you had $100,000 or $200,000, you could probably buy a property that was worth 3 times that, assuming that you're putting about 25% down in most investment properties, and then the closing costs and maybe some rehab costs as well. So you could probably, if you had 100,000, you could buy a property worth 300,000 reasonably. But a more effective way is to pool and invest money with other investors and then buy a much larger property than you could. So this is ideal for people who have full-time jobs and who don't really want to manage a single family rental or another property, but still want to invest in real estate, get that exposure to real estate, have the portfolio diversification, but not put in the time or effort to do that. So there are two parties in a typical investment. So you have a sponsor who's actually putting the investment together. They get their time and experience, and the passive investor puts in the money. The sponsor also, you want a good sponsor to always put in their own money and have skin in the game. You never do an investment. I wouldn't recommend an investment where the sponsor is not putting their own dollars. So let's look at a sponsor role. A sponsor does the underwriting, identification, and acquisition of the asset. When I talk about underwriting, it's essentially a fancy way of saying you make figure out the numbers for the property and figure out what the 5 years of ownership looks like. Typically, these properties are held up to 5 years. During which we perform a whole lot of value add to the property, like basically a rehab to the property, increase the net operating income of the property. But we also have to look at a lot of properties and work out the numbers on it, which we call underwriting, similar to what mortgage folks do. When they give you a mortgage, they do underwriting. So we identify assets. So we also maintain broker, lender, and investor relations. So we have to talk to lenders. We have a team of lenders. We have a team of brokers that we work with to identify these properties. We work with attorneys to form all the legal and LLC documentation to have this done. And this is considered as securities. So we have all the securities laws in place when we work on these investments. We also work with property management companies. So we don't go try to manage the property ourselves. Maybe that would be low cost, but the scale that we're dealing with, like 100 units, 200 units, we hire professional property management company. They do this really well. They know what they're doing, and they bring on-site staff, and we pay the staff as well. They'll be payroll. So they actually implement the business plan that we lay out. So every property you can think of as its own business. We buy a property, we lay out a business plan for the property, and then we execute on the business plan for the property, and then we sell basically the property based on what our business plan, how it works out, just like a business, except it has a start and an end date in mind. And sometimes it could be earlier, it could be later, depending on how the market's doing. Obviously, right now is not the great time to sell, so we just hold and ride it out. We also dispose the asset and the distribution of investor funds, both during the property hold period as well as when the property is sold. So let's look at a passive investor role. They provide the cash investment, receives a cash on cash distributions on a regular basis. Usually we do quarterly distributions every quarter. We also provide property reports on a regular basis. to the passive investors. And the passive investor is mostly an equity investor, but there's also some investments where we structure them as debt investors. So you can have a flat return from as a debt instrument versus doing equity. So I want to briefly cover some concept here, which is useful for, I mean, a lot of folks who are investing probably know this already. So this is just a recap. I want to cover the concept of cap rates because this is critical to understanding how we work with these multifamily investments. So a capitalization rate or cap rate is defined as NOI divided by value or price times 100. So NOI is the net operating income, which means that's the money we are making after paying all the expenses. So it's income minus expenses is NOI, but NOI never includes, it does not include the debt service, which is the mortgage payments. And there's a good reason for that, and I'll come to that. But NOI is essentially income minus expenses divided by value times 100 is cap rate. For example, if the NOI of the property or the net operating income is 100,000, the value, let's say you paid a million, then you're buying it at a 10 cap. So this is a popular measure for assessing real estate investments for their profitability. It represents the yield of the property over a 1-year time horizon, assuming that you paid all cash. So if you paid $1,000,000 for a property generating $100,000 in NOI, then you basically bought it at a 10, you're making 10% on your money. So it's a 10 cap. It's as simple as that. Cap rates are usually proportional to the perceived risk of investing in a market. The reason I'm saying this is you'll not find a 10 cap property in Austin. But if you go to Brownsville, you might find a 10 cap property in Brownsville. Now you might think, oh, Brownsville is a better investment if I'm going to make more money. That's kind of how I thought initially when I got into the multifamily and commercial game, is that I just wanted to increase the amount of money I got, right? Seems like a normal thing to do. But the interesting thing is, when you buy a property at 10 cap, you're usually not buying it in a favorable location or a favorable city that is going to do very well. So what you make up in cash flow, you might lose on the equity gains. So what I'm saying is if I put $1 million in Austin or $1 million in Brownsville, Texas, guess where I'm going to make more equity gains? Obviously, it's going to be Austin, given all things kept equal, because even though I'm cash flowing at a higher rate in Brownsville, I'm not going to make the kind of equity gain or appreciation that I can make in Brownsville that I can make in Austin. So generally, the way it works is when you start seeing good numbers for cap rates, it usually means there's a high risk or a location's not very great. And whenever you come to Austin or you go to San Francisco, someone's telling me it trades at 2.5 cap, which means you make $2.5 for every $1,000 you put into the property, which is really, $100 you put into the property, which is really, really low. So that's sort of understanding the risk of the market versus the cap rate. So low cap is generally low risk because people are willing to get much less money in terms of cash flow for investing in that market, because people believe that the market's going to do well and the returns on the equity portion are going to be much higher. So in terms of multifamily classes, it's good to understand these three classes, A, B, and C. Generally, we classify Class A apartments as apartments which are less than 10 years old. They have a high level of amenities. A lot of few folks who are living in apartments or who might have lived in the past might have lived in a A or a B apartment, because there's usually the tenant demographic is people who are making higher median income. It's a really fancy property. It has a dog park, has all these valet trash maybe, and nicer amenities, right? It's a newer apartment, so the deferred maintenance or the repairs required is very low. And the cap rates given a market we talked about is the lowest in the market. So if you come to Austin, your Class A's might be trading at a 3 cap, but your Class C, which is the other end of the spectrum, it may be trading at like a 5 cap or a 6 cap. So depending on the age of the property, the cap rates change as well. So your Class B is sort of smack in the middle. It has medium amenities. It's not that old, maybe 10 to 25 years old, which is not very old from an apartment age standpoint because it's usually renovated, kept up. It has really good tenants, a strong tenant base who make good income. And the cap rates are usually right down the middle. This is sort of the class that I prefer, and most of my partners, we kind of gravitate towards the Class B apartments. Although there is something to be said for the Cs, you can do a lot, make a lot more money on those, although their risk is a little bit higher because you have tenant demographic, which is usually low income. They have a lot of, you could inherit a lot of pain, like in terms of rehab on the property, a lot of maintenance issues. So the age of the property is generally older, but then you also have the potential to make most money on the Class C apartments, depending on the market, right? You'll get it at a higher cap. And also when the market's going up, like it happened from 2009 to 2012, 15, 16, 17, people made a lot of money on Class Cs. So as you can guess, this is a Class A apartment. I just wanted to give you an example and you can very clearly see it. This is what an example of a Class B apartment looks like, somewhat older, but not really run down by any means. And this is what a Class C apartment would look like. You can clearly again say that, okay, they have individual HVAC units, probably a 70s, 60s or 70s product. Okay, there's one question and I'm going to answer that before I move on. Naga asks, can we call a multifamily as a commercial property? Obviously, definitely yes. When we're talking about over 5 units, it's considered commercial. So when we talk about 100-unit apartments, it's still considered a commercial investment, even though it's a residential, like it's a place where people live, it's still considered in the commercial realm. So let's talk about some of the advantages of passive real estate investments, especially the real estate part of it, right? There are a lot of other passive investments. What are some of the advantages of investing in real estate passively? So you have the passive income, which we already talked about. We have forced appreciation, and I'll talk about what that is. We have tax benefits. We have a very high amount of depreciation, and I kind of alluded to that a little bit in the single versus multifamily discussion. It's a recession resistant asset. Again, it's not recession proof. And this is probably the best example of what we're going through right now is the best example of that we can't ever call anything recession proof. It's recession resistant. It handles it much better than the stock market. When the stock market dips 36%, we don't dip 36% in 2 days or 5 days or even a month. We have economies of scale. We allow for portfolio diversification, and there are some of the other benefits that I'll talk about. So passive income, again, we talked about what passive income means. Investor puts in money, no time or effort. Cash distribution usually paid from the cash flow, usually on a quarterly basis. Now, we talk about the net operating income being income minus expenses. Some of the income would be rent, pet rent, laundry, utility bill backs, parking, late fee. If any of you lived in apartments, they might master bill the water and then bill you back for the water, and that's a utility bill back. Expenses, property payroll, repairs and maintenance, contract services like pest control, marketing, leasing. We keep aside reserves as well because we have to kind of work with the reserves on a rainy day like this we're having right now. Cash reserves are really important. So the net operating income is defined as income minus expenses. And cash flow is the actual cash flow is net operating income minus the debt service. So the reason we don't include debt service in the net operating income is because everyone can take a different loan and the cash flow of the property will be different. So if you're putting more money down and getting let's say a 4% loan, and I come in and put less money down and take a 4% loan, our debt service or loan payment might be completely different. So we can't really account for that when we talk about the property. We have to talk about the property in terms of its income and expenses. And the debt service is not a part of it because someone could buy it all cash and make that net operating income as the income on it. So your cash flow ultimately determines your cash on cash distributions, which happens every quarter. So we'll talk a little bit about forced appreciation. So in multifamily, I mentioned there were two factors which determine the value of the apartment, which is net operating income and the cap rate. And the cap rate is not only determined based on the market, but also the sub-market. I don't know how many of you are living in Dallas, but for example, we have a property in Irving. It's a very good sub-market, right? Like the schools are really good, the prices are really good, the tenant base is really good. But if I take another submarket like South Dallas, we can't compare the two. So the cap rates will be different from submarket to submarket. So what might be trading for, let's say, 5 cap in Irving might be trading for 6 cap in South Dallas. So this is when I mean what I mean by submarket and market. So essential to all these investments, all commercial investment, not just multifamily, is that basically the play is a lot of times that we go in and figure out how can we increase the net operating income. This is called the value add play, where we take the property and we say, how can we increase the income? So there are two ways we can increase income. We can reduce the expenses, or we can increase income. And then we increase the NOI of the property. So usually we try to do both in whenever we get into an apartment. And forced depreciation is basically identifying all those factors to increase the NOI and increase the valuation, because the value is essentially so coming back to this, so the cap rate is NOI by value times 100, but the value is NOI divided by cap rate times 100. So we can increase the value for a given cap rate by increasing the NOI of the property. Does that make sense? So let's look at an example of post depreciation. So we have a 20 unit apartment and a purchase price is $1 million. I have rent of $1,000 per door, which means per unit. And that means I'm collecting 20K per month, assuming nobody's not paid and all those issues, right? Like just gross income. We're assuming everybody's paying and everybody's being charged $1,000. This might not be reflective of a true situation, because someone might be paying 900, another person might be paying 1,000, somebody might be paying 1,100. So it could be all over the place. But this is just an example. So our income is 240K per year, the rental income. We have expenses of roughly 140K a year, property taxes, insurance, repairs, property management, all of it. So your net operating income now is 240 minus 140, which is 100K. The purchase cap rate is NOI divided by purchase price. So my NOI is 100K and a purchase price of $1 million, I'm paying a 10 cap. Pretty simple. Now, let's say in 2 years, I decided we're going to sell. But in those 2 years, we increase the rental income by 50 a door. And that's not even for entire 2 years, right? So $25 per year. So the first year we increased 25, the next year we increased another 25. So the total increase is $50 times 20 units times 12 months, which is 12,000 per year increase, right? Now we reduced 8K per year in expenses. So it's cut down. So the new NOI is now 240 plus 12K, which is the increase in income, minus 148, which is 140 minus 8, 132K. So our net new NOI is 120K. So what happens to our value, assuming that the cap rate is the same, our value is now 120K divided by 10%, which is 1.2 million. What we've essentially done is just by increasing the rental income for by 12,000 in 2 years and reducing the expenses by 8,000 in 2 years, we have increased the value by 200K just for a $1 million apartment building. Now, assume that you have a $10 million apartment building. We could have achieved a $2 million increase with the same logic. So that's essentially what we do in this business. We take an existing apartment or hotel or anything else, and we increase the NOI and we achieve what is called forced depreciation. Because the appreciation is not based on the comps, it's based on the cap rate and the NOI, we are able to modify the NOI and increase the valuation. Any questions on this? Okay. So coming to the tax tip benefits, we have single family depreciation. A lot of you must be familiar with this if you have rental homes. So let's say I have a house for 200K. I have a land which is 75, the land on which the house is sitting is worth 75K. My depreciation is not on the land, it's only on the structure. So it's going to be 200 minus 75. Divide that by 27 and a half years. So that's your depreciation per year is 4545. Now your tax savings on it will be your whatever your tax rate is, your marginal tax rate, times the depreciation. That's your savings. That's, let's say, 30% of this value, 4545. If you're on the 30%, then yes. Okay, there is a question. Is it practically possible to decrease expenses 8K in 2 years? Absolutely. We do this all the time. So what we do when we buy these apartments is we look for places where we know that it's not being well managed. A lot of these old owners are rents are under market, right? Like they're severely under market where they own the property for 15 years. They haven't really brought the rents to market. So they're your next door apartments charging $100 higher. And then we notice that, oh, they're paying for water, they're paying for sewer, they're paying for everything. So it's actually really easy when we find apartments like these where we know that we can bill back water because everybody in the neighborhood is billing back water except this apartment because this owner has owned it for so long and doesn't care, hasn't kept up. So we do this all the time, and it's absolutely easily possible that you can decrease expenses by 8K in 2 years. So coming back to the depreciation. So we talked about the 30% tax rate and then the depreciation. So essentially you've saved 30% of it in tax, whatever your tax rate is, times the depreciation. Now, coming to multifamily depreciation, we do something called cost segregation, which is very unique to, I won't say it's unique to multifamily or commercial investments. It actually can be done on single family investments. But the factor is that the cost segregation study is so expensive that it doesn't make sense for most single family. It might make sense if you're in California to do cost seg for a single family where your house might be worth 2 million, but it doesn't make sense when it's worth 200, 300, or even $500,000. So what the cost segregation study does is it says, okay, I have plumbing, I have electrical, I have all the electrical fixtures. Now these can be depreciated on a different schedule, and it doesn't have to be 27 and a half years. So it can be depreciated actually over a 5-year period. Now, what's even better is on top of that depreciation. So let's say now we have $1 million apartment and we figure out that, oh, the plumbing, the electrical, all of these can be depreciated now on a 5-year schedule instead of a 27 and a half year schedule or 32 years in commercial properties. Then we can collect the depreciation in a much shorter period of time because now we own the property for 5 years and we can collect it over 5 years. But what's even better is we have a new act now, which was released in 2017, which is called bonus depreciation. So we can take 100% of the depreciation in the first year. What that basically allows you to do is get a big loss on your balance sheet, on your tax savings. So you can offset any other income you have with that loss, it's a paper loss, basically. So it provides significant tax savings to offset any gains. So let's say you sold a house and you realized a big chunk of change selling the house that you couldn't really offset because it wasn't your own home, like you didn't live in it or whatever, it was a rental property. Then you could invest that in apartment, get a big depreciation, and then offset that use the depreciation to offset your gain in the house. So it's quite possible to offset get some tax savings for gains that you have elsewhere. So typically we see a first year investment. Nowadays, I'd say the range is more 40 to 60, 70,000. We've seen it as high as $90,000 depreciation in first year. So there are a couple of questions and I'm going to answer them. When you have forced appreciation, how do you determine the cap rate? The cap rate is determined by the market. So right now, let's say Austin's going at 4 cap, 5 cap, something like that. And what's interesting is that as the market loses steam, like it's happening right now, we expect the cap rates to go up. Essentially means values come down. right? Because cap rates and values are inversely proportional. Um, how long do you hold these properties? Do you sell when you achieve a specific return? Yes, absolutely. That's exactly what we do. We plan to hold it for 5 years, but if we can achieve the return faster, the return that we plan, which is usually 100%, anywhere from 85 to 100% return, then we sell it faster. So what do I mean by recession resistant asset? Housing is not a discretionary expense. There are a lot of discretionary expenses. Housing is not one of them. People might stop going to restaurants, might stop drinking outside, lots of things, but people always need a place to live. So we feel like multifamily is a very recession resistant asset in that case. The millennials and baby boomers are moving towards renting because they just don't want the hassle of buying properties and taking care of properties. We have low occupancies during downturns. Even though occupancy, let's say retail occupancies or vacancies actually go up, we usually have pretty high occupancies through downturns. Actually, it should be high occupancy, not low. Can cash flow in spite of vacancies and bad debts? So right now, let's talk about what's going on right now. Um, we were predicted doom and gloom by everybody about how people are not going to pay rents and everything's going to go down. We have had minimal impact on our April collections. So by minimal, I mean we always have delinquencies, and that's why it's economies of scale, right? Like we aren't, if you have a single family home, it's either occupied or not occupied. It's the tenant's either paying or not paying. You're 100% affected. But when I have 200 units and 10 units, they don't pay me, I'm still okay. I'm still cash flowing. So that's what I mean by economies of scale really help us when there's bad debt, people can't pay, people lose jobs, whatever. There's still a big significant portion who are paying. So in our, just to give you an example, in our Class B apartments, I think we've had like 6% delinquency or 7% delinquency max, which means 6 or 7% of the tenants didn't pay on time, and they'll catch up, right? But they might not pay on time. We're still fine. We are able to make all our payments and be fine. So the valuation, again, depends on cash flow NOI and not the comps. That really helps because when the market goes down, single family assets come down because your comps are coming down. We are not based on the comps, we're based on the cash flow and NOI. Although the cap rate is based on what the market cap rates are and they can go up, we always factor that in when we buy apartments. What I mean by that is, let's say I go in today, I bought a property in Phoenix at 4.5 cap. When I did my underwriting, which is the financial analysis, I assumed that the market will sit at like a 5 I think we did like a 125 basis points higher, which means 5.25%. I assume that the market will be worse when we're selling. So it was a 5.25 cap. And then I calculated what we'll sell it for based on a higher cap rate, which means the market's not as favorable as when we bought it. So we always account for the cap rates going up, and we make sure that the numbers still work when the cap rates go up. So there are some questions, so I'm going to try to answer them, or Kishore, should I hold them to the end?
Yeah, Kavitaji, maybe, yeah, you better hold them to them.
Hold them to the end. Okay. So let's talk about the economies of scale. I think we covered this. Purchase cost per door, rehab is lower, property management cost is lower. We're also able to protest taxes more effectively than single family homeowners, right? Like being a single family homeowner, I know how difficult it has been in Texas to protest taxes. We have a lot more leverage when we own multifamily or a large apartment or even hotel to protest those taxes. We tolerate physical vacancies better, tolerate bad debt and loss to lease. Loss to lease is another term you'll hear a lot. It essentially means below market rents. So if your rental, let's say it's $1,200 a unit is your market rent, and there might be units leased at $1,000. So it's basically you're losing $200 to lease to your market rent. It's called loss to lease. And I mentioned this before, it allows for portfolio diversification. A lot of folks do stocks and index bonds. They provide historically much lower returns if you look at the period of time. Even though in a short time, stock and index funds might go up significantly, but they also are highly volatile, so they can come down significantly as well. And you have no tangible asset there in stocks. Whereas in real estate, it doesn't go down very significantly immediately. Like, it doesn't react the way stocks and funds react, right? Like the exposure is higher return investments. So typically we do about 15% returns on our investments over a period of time. But you also have the tangible asset, and it doesn't fluctuate. It's not highly volatile like stocks and index funds are. So you can also get exposure to different markets. So let's say you are in Dallas and you are buying single family homes in Dallas. It's unlikely that you're going to go to Vegas or go to Phoenix and invest in a single family home. But when doing passive investments, it's completely probable that you can do that, because you're not really boots on the ground managing that investment. You're asking someone else to manage it for you. So it allows you exposure to different markets. So some of the benefits you can leverage from experience of the sponsorship teams who have done this for years, right? If you're a new investor and you don't know what you're doing, it's better than buying a single family home and trying to figure it out. You have professional property management teams that do rehab, leasing, maintenance. So it's managed at a very high standard versus doing it yourself or trying to hire a property management company and pay them 8% for managing a single family home. The accounting is also managed by the sponsorship as well as the property management team, and they provide you all the documents that you need for tax purposes. So you don't have to deal with all the accounting and filing for taxes yourself. I mean, you'll get the document, you still have to use it for filing, but it's all done for you. You're not worrying about all the income and expenses and how much you made and how much you need to put together all the accounting. So you're not dealing with tenants, toilets, not dealing with non-paying tenants, none of that stuff. So some other benefits are, what's important to notice is that commercial loans, we do a lot of what is called a non-recourse loan. With a non-recourse loan, is very distinct from when you go out to take a mortgage. It's called a recourse loan, where your credit is on the line. So if you default on the mortgage, your credit is going to get trashed, right? But as a non-recourse loan, there is no personal credit on the line. The sponsors are the guarantors for the loan, but non-recourse means that the building is held as a collateral. So you're not really putting your personal money online anywhere here. So you're in the same token, there's no liability. The property is purchased as a part of an LLC, so you're protected from liability issues. You can create an LLC for your investment if you really want to, and then purchase into apartment. Like, I have people, 2 or 3 friends will get together, create an LLC and invest passively. So that's an option if you really want to, but it's not necessary. So coming to the typical returns, like I mentioned, the total returns have a cash on cash component and an equity component. Typically, the cash on cash component is between 7 and 8% before this whole COVID crisis happened. I hope and believe that this will go up if we can get better deals. So it'll be closer to 10% or so if we can get better deals, considering what's going on in the market right now. And the equity returns is the other portion of it. So let's say I tell you, hey, the total return is 15% per year annualized. Then it's basically 75% return over 5 years. And part of that return is that 7 or 10%, which is cash on cash. And part of it is the equity returns when the property is sold. So obviously the equity returns don't come to you until the property is sold. So can there be cases where the cash on cash returns can be impacted? Absolutely. Right now, with the what's going on, we are holding off some of the properties. We are holding off all distributions right now, because yes, we could possibly pay the investors because we are getting paid. But what happens next month if we don't get paid, right? So we are taking a proactive approach and saying, okay, we are slowing down, stopping all distributions. But once the economy gets back on track and things get back to normal, somewhat normal, we'll start resume the distributions. But until then, we'll hold on to cash because we don't know what the future looks like. So cash flow can be impacted. But I think the bigger picture is that you have to look at the total returns at sale rather than just the cash or cash on cash returns. So I just want to talk about a few investment plays. What we call a value add play versus an yield play, and what's a hybrid play. A value add play is typically what I told you about, whether we do the forced appreciation. So we can add value by increasing the NOI in many ways. We can upgrade the units to increase rents. So we say, okay, I'll put a nicer unit versus an older unit. I'll charge $100 more for the nicer units. I can take unused storage. We have done this in a lot of apartments where there were like 5 storage units. We're like, okay, we don't really need 5 storage units. Can we turn some of these storage units into actual units so we can increase the number of units which are rentable and making us money? We have implemented reserve parking. Some of the apartments, they had really bad parking situation. We say, okay, you want a reserve parking, you pay $25 a month. So we increase the income. A lot of times this requires some capital expenditure, which means some kind of dollars we have to put in. Sometimes it doesn't, right? Like we have implemented reserve parking by painting a number on it. A number costs us $5 to paint. So that's not really a huge CapEx budget. We have the other side of it is called the yield play, where let's say I go to Brownsville, I'm making 10% cash on cash returns, or I'm buying it at a cap rate of 10. I mean, it's making a lot of money, because now imagine that's without leverage and I go put in a mortgage for 3.5%. I'm going to make more than 10% on that property in terms of cash. So that's called a yield play, where we don't really have to fix up anything. We are cash flowing the way it is. So that was really hard before, as we got towards the end of this high boom. But I'm hoping that once we start getting less expensive properties, it's possible to do just a yield play again. And the hybrid is the combination of the yield and value play. You take advantage of the cash flow, but you also increase the NOI by adding some value. And the value add might be very minimal. All right. A few other topics that we need to talk about. Who's an accredited investor? And this is relevant because there are 2 offerings we usually do. And I don't really remember that I put in those slides. It's 506C or 506B. When we have a 506B offering, we can do either accredited or sophisticated. And I'll talk about both. When we have a 506C offering, C as in Charlie, then we can only take accredited investors. And I'll talk about who the accredited investor is. Defined by Securities and Exchange Commission as someone who's earned 200,000 or more in each of the prior 2 years and reasonably expects to do the same for this year, or 300,000 with a spouse, or has a net worth of $1 million, excluding the value of the primary residence where they live in. It has to be a net worth of $1 million or more. Need not be an individual. It can be a trust, a bank, a partnership, or a nonprofit, depending on the situation. What we call a sophisticated investor, we just expect people to have enough knowledge and experience in investment related matters to evaluate the risks and merits of the investment. We have no income requirements, and we can sell our securities, and we are considered, when you have an apartment, it's considered a security, like a syndication. Then we can sell the securities to an unlimited number of accredited, but only up to 35 sophisticated investors in a given investment. And this is for the 506B offering. The 506C is only open to accredited, and we do both depending on the investment. So how can you invest? We talked about cash investments. That's an option. You just put in cash from your bank account or wherever the cash is from. There are tax implications on the distributions, but usually you can offset it by depreciation. So you end up really paying no taxes on the distributions. On the sale, yes, there will be taxes, and there are some ways to get around that as well. You could do another investment, collect the depreciation, and offset the taxes on it. Just checking the time. So a self-directed IRA investment. So you can invest through your retirement accounts. We see a lot of investors do what we call an SDIRA, which is a self-directed IRA. The tax-free contributions, you can roll it over from a self-directed IRA can be rolled over from an existing employer 401k when you have left the employer usually, or another IRA. There are no tax implications on any distributions, but there is a tax which is assessed on an IRA investment called UBIT, and you should be aware of that. And a lot of people will say STIRA is a tax-free vehicle to invest in, and that's not true. UBIT is called unrelated business income tax. So when you buy an investment that's leveraged, which means we place a debt on it, we take a loan on it, then you will be charged UBIT for the leverage portion of your gain. So let's say I invested 100,000 and I made 100,000 on top of it. So I made 200,000, essentially total of 200,000. Now your portion, the entire gain is 100,000, but let's say I leveraged it at 75% LTV, loan to value. Then my leverage portion is 75,000 of that $100,000 gain, and there will be UBIT on it. It's like 33% or something really high. So I always tell my investors that they should look into solo 401k or QRP, which is a qualified retirement plan. And it says that it's available to self-employed business owners, but truly you can set up any business. You can go set up an Amazon store and become an active income business and set up a solo 401k using that business and roll over your IRA into a solo 401k. And I highly, highly recommend this. I don't recommend SDIRA as a good investment option because there is a lot of issues with UBIT when you have leverage investments. Um, yeah, I think that's it there. So a quick, I went through this last time as well, but a quick impact, COVID impact. We have tenants who need not pay rent according to the government for 120 days because they put a moratorium for evictions, which means a lot of the C properties, people can say, you know what, I can't get evicted. I don't want to pay rent. It's possible, but thankfully we're not seeing that. People know that after the 120 days is over, they'll have ruined their credit. They'll probably get thrown out because they'll never be able to catch up. So all those factors are making people pay on time and still pay, right? So they're not like saying, okay, nobody can evict us, so we're not going to pay. Especially the AB, we're not really seeing much issues. We're not seeing any collection issues there. They also have put out some forbearance options for landlords, and frankly, being apartment owner, I think the forbearance options are really not an option unless you're in deep hole. And we have good enough cash reserves that we can use to tide over if it comes down to that. The good sponsors are streamlining the operations and reducing the capex and the opex. So let's say I raised $500,000 to do apartment renovations. Guess what? I'm not doing the renovations right now. I'm going to stop that because it makes no sense given the current environment. It's not like I'm increasing rents or doing anything. There's no reason for us to renovate. We just want to rent at market and be fine with it. So we have to kind of change with the circumstances. We can't just, our business plan didn't factor for COVID. We factored for maybe a downturn, but not COVID, right? So we have to kind of play with what happens. And that's like any business. We have to run with what's going on in the market. So what do I think the opportunities from this crisis will be? The prices are going to head down because a lot of those landlords who'll take the forbearance options will actually be dig themselves a deeper hole because at the end of the forbearance period, they have to pay up everything. And I don't think people who didn't have cash reserves before are not going to come up with cash reserves after 6 months. So my guess is they're probably going to go into foreclosures, and we're going to see a big wave of foreclosures hit the market around the third quarter and fourth quarter of this year. And we're hoping that'll happen because that'll give us a buying opportunity. The cap rates will increase across the board in every market, which is good because it was too compressed for far too long. So we'll have better cash flow on these properties. So I always wanted to invest in Austin where I live, but just never saw an opportunity to invest. The cap rates were so low. But I'm hoping if the cap rates go up, we'll actually find investments in Austin because I still like Austin as an investment market. It's a great city. It's growing. It's only going to grow in the next 10 years. Some asset classes like hotels are affected heavily, and we might be able to get some really cheap, dirt cheap buys there. So if there is cash flow, I mean, the hotel business is going to come up. It's not going to be decimated. People are not going to stop traveling forever, right? So our focus will continue to be on strong growth markets, DFW, Phoenix, Austin, San Antonio, and others. So we're not going to change that strategy. We don't like to go to Brownsville or wherever because the cash flow is higher. We like to stay in markets where the appreciation is the highest. Okay, that's it from me. Questions? So I think I have a few questions I'm going to answer. How long do we hold these properties? The tax savings from multifamily depreciation, don't we pay taxes on that when we sell the unit? Yes, you do. There is something called a depreciation recapture, which is a portion of the depreciation that you take, not 100% of it. So there will be depreciation recapture when we sell the apartment, which is why we say, let's say I sell it in 2022 tax year, then I say, you know what, roll that over to another investment where you get depreciation again, so you can offset what gains you got from the previous investment. As long as it's in the same tax year, the depreciation can be applied. I hope that makes sense. We have been trying to get into the single family business and face similar challenges you mentioned. What would be the minimum investment? Oh, okay, I should talk about this. How's the return quarterly? So the minimum investment usually about $50,000 for most of these investments. The returns I mentioned already, 7 to 8% preferred return, which means the 100% of whatever 7 or 8% we make goes straight to the investors, and we don't get paid anything until after the 8%, or the whatever that we call the preferred return is. The interest is paid quarterly, yes. With mortgage rates so low, we would not have lower occupancy rate in those units. Okay, no, we don't. Actually, what happens in a downturn is people are afraid to buy, right? They don't have the money to buy, or they are just worried about the market. So we don't usually see a huge buying activity as far as people buying it for living in it. They actually prefer renting. So interestingly, I bought my first house in 2009. I had no trouble renting it in the middle of the downturn. So renting is usually doesn't hurt because of downturns, because there are more renters than buyers in the market during a downturn. Do we know self-directed IRA funds? I think I answered that question. You can use your SD IRA. However, I recommend a solo 401k or QRP. In a 200 apartment complex, what's the typical vacant apartment percentage, and what's the typical delinquency? Are these factored into the expected NOI? So when we do the financial analysis or the modeling that I call underwriting, we actually take into account all of these factors. We look at the average vacancy over the last 12 months, when we call what we call the T12, or the trailing 12 of the apartment, and we figure out, okay, what are our assumptions? We actually go over and above what we see, because we assume that we want more units vacant when we want to rehab them. We also assume a certain amount of delinquency depending on the apartment. So if we're looking at a class C, we might assume a higher delinquency than a class B apartment, right? So we all factor that into our calculation as far as what the expected or the projected NOI is for the next 5 years. We usually keep what we call economic vacancy. We usually factor about 10 to 15% of economic vacancy, but probably on the higher end the first couple of years, because we are going through renovations. We are maybe going through a downturn right now. Obviously, our economic vacancy will be higher. The economic vacancy is physical vacancy, delinquency, takes into account all those factors. It's the actual economic vacancy because you're not realizing that money for all the economic reasons, right? Including physical vacancy. Is there a way to get mortgage loan from banks for investment and get passive income? No, you cannot get a loan to invest into this investment. I don't recommend that. Yeah, I still don't recommend. I don't think anybody's going to lend you a loan to do a passive investment. That's not how it works. Because when someone is giving you a loan, they expect a collateral, right? So you can't use the building as a collateral because we are already taking a loan against the building. So you can't say, I'm going to invest in an apartment, let me get a mortgage loan. Yeah, so I don't recommend it, and I wouldn't say you should do it. The smallest investment you can make, we have gone down as low as 25,000. It's really like the smallest investment. We usually stay above 50,000. Is 401k considered a part of net worth for an accredited investor? Yes, I do believe it is considered your part of your net worth. Except for your residential property, that is where the one you're living in, your homestead, everything is, all the other money that you have is considered a part of your net. Who holds the title to the property, investor or sponsor? Neither one of us. The LLC holds the title to the property. The LLC, which consists of both the investors and the sponsors. If I have to withdraw my investment, what is the process? There is no withdrawal. This is not a liquid investment. Real estate never is, right? Generally, it's not a very liquid investment. This is not a liquid investment. There's no withdrawal process as such. So that's why I recommend a lot of people, hey, use your retirement accounts, because it's not like you're in a hurry to take your retirement and or you're retiring tomorrow, right? Did you say there's a cap rate on cash on cash? No, there is no cap rate on cash on cash. The cap rate is just the return, the yield of the property. What market is best for rental property in Texas? Austin, Texas, and Dallas or Houston? I don't know what it will shake out to be. What do you mean by best? So sometimes you have to sacrifice cash flow for equity returns, where you're saying, hey, this property grows at a much higher rate, but I don't make as much cash when I'm holding it. So it just depends on what your criteria for investment is. So what are this? It returns 7 to 8% annually. What are the best and worst case annual returns? So I'd say the worst case annual returns will probably be 2020, for example, where we're not going to do any returns the next quarter or maybe another quarter from now. But usually when we do call what we call a preferred return, 7 or 8%, let's say. And let's say this year I'm able to only make 4% returns because I'm holding back the returns. Although I'm making money, I'm holding cash reserves just to keep the property safe. Then I still owe the investor 4% for the total of 8% return. Then we'll play catch up on that 4% over the next few years. So instead of being maybe 8% a year, we'll do 9% a year for the next few years. So we'll do catch up when it's a preferred return. Can you give me an overview of your current investments and how many properties you're managing? So right now I have 650 units that we are managing, me and my partners. We are across Phoenix, Dallas, and Atlanta. If you buy from a mom and pop owner, then it's not getting economies of scale. But if you buy a bigger property, then might be managed by a professional investor who had done a value addition already, then can you add more to it? Okay, so this is a good question. I like this question because this is true. You know, we buy a big property, it might have already gone through all of this value add, but there might be some more value add. So a lot of times when we buy a large property, maybe the investor bought it 10 years ago and did like value add for the first 5 years. The next 5 years, they're like, hey, you know what? We're just cash flowing. We don't need to do any more. So there's always opportunities for us to go in and add value, even though there's been a value add done. Usually most investors will not go in and rehab 100% of the units. They might do only like 20 units out of 100 units. So they'll still keep meat on the bone for the next investor, and that's kind of how it works. But typically what we do is, it's not necessary that because it's a owner for 18 years, it's a mom and pop owner. We have actually bought like 100 plus unit properties from someone who held it for 18 years in Phoenix recently. And we bought it, and that guy hadn't increased rents in like 5-6 years, the last 5 years. And Phoenix had gone through, I mean, I'm talking about $500 rent increases, $400 rent increases. And you can imagine if $50 can change a property value, what $400 can do to the appreciation of the property. So yes, it's quite possible that we buy from a mom and pop owner who's a very large owner and has multiple properties and hasn't really paid attention or just held on. He's really old. He's 65 years old. He's done with this. He wants out. So we always look for properties which have been held by the same investor for 10 plus years, because it gives us better opportunities to go add more value. you have any open opportunities or investments coming up? We are working on a few. We don't have anything right now. The reason is we really can't close on anything. We can't do due diligence given the quarantine. So everything is kind of in the negotiation process right now. That said, I do believe there'll be more opportunities coming up in the future. So I can keep people posted. You can go to my website, cherrystreetinvestments.com. And I think I have it somewhere here. Yeah. Oops. There you go. Um, cherrystreetinvestments.com, and there's an invest button, and you can stay updated. If you hit that, if you enter your details, then you will get auto update whenever I have an opportunity open. Question about Lubbock. Cities like Lubbock, not a good place to invest. They are smaller but upcoming cities. So, Sarita, I'd say, let's say I go by in Lubbock. I'm looking at what are the job opportunities coming up. What happens? What is the primary source of revenue in Lubbock? Probably the university. What happens when the university is shut down, like right now? We're talking about universities not being open the next school year. I mean, I'm not talking about 2020 school year, but 2021, like the next school year. So that's going to be hugely impacting cities like that. So I like cities where there are multiple jobs, meaning different sectors. It's very diversified in its economy. It's not a one-trick pony. Like if I go to Odessa, Midland, I'm talking about an oil-driven economy. Is this a good time for that? Probably not. So I like markets where, I mean, there isn't one business. There isn't one type of business involved, right? There's a multiple sectors. There's multiple. It's a very resilient economy. So I would rather pay more for that than to go to Lubbock and to put in my money in Lubbock. Not to say Lubbock is a bad market. I'm just saying that we are not in the business of doing that. And especially as we come out of a recession, I actually think that the better opportunities will be in the big, strong markets. How long do we need to keep the money? Usually 5 years. Does the investor have a lien on the property? No, investors don't have lien on the property. So we basically use the mortgage company has a lien on the property. Just like you go, let's say you go buy a house, a single family home, you don't have a lien on the property. You are in the second position because the mortgage company has a lien on the property, right? So it's the same position here. You put the percentage 30% down on the property. You're not the lien holder. How can it, I don't know what this question is, how can build wealth? I'm not sure, Ram, if you can clarify your question. I meant final annual return. I'm not sure what that is. If I didn't answer your question, please re-ask it. I'm not sure I understand some of these questions. There is no guaranteed return. It is depends on what's going on. Like I mentioned, this year we probably won't pay 8%, right? So there's no guaranteed return. The only guaranteed return you can get is probably a savings account, or a life insurance policy is a great place to get guaranteed returns. But whenever a return is guaranteed, the returns will be lower. It's just a fact of life, right? So, question from Sachin: what market is best for rental property in Texas? Austin, Dallas, or Houston? I'd say of the three you mentioned, probably Houston has the most cash flow. If cash flow is your concern, you're not going to see much cash flow in Austin or Dallas yet. That might be coming. Can I create an LLC and invest? What are the benefits of individual LLC? My contact details are on here. You can create an LLC and invest. There's no benefit to it, to be honest, because you're already sitting inside an LLC when you invest. So we have multiple LLCs actually. So you'll be inside a investor LLC. There is a sponsor LLC. There's another LLC which owns the apartment. So you're really well protected. Liability is less of an issue than when you go and buy a single family home. That's when you really need to worry about a liability and asset protection, because you own the home. The tenant can come after you if anything happens on the property. Let's say you keep a property for years with 2 years down the market and 3 years with a good market. So five years total, what's the best and worst case rate? The rate will depend on the property. We actually, when we do a property presentation, we actually do a 1-hour webinar. We talk about that specific property and tell you, okay, this is what we're anticipating for 2 years. Maybe it's a down market. Maybe we won't be able to push up rents. Okay. But next 3 years, but here's the cash flow. The cash flow is really good because we bought it at such a great rate. Maybe we can't do the value add, but we will plan to do the value add when the economy turns around, and maybe we'll do 3 years projections. So that projection depends on that particular apartment. Like I said, it's a business. Every apartment is unique and it's an individual business, and we will tell you the business plan for that particular apartment and the projections based on the apartment. It's not just some big, hey, this is the, I can give you a range, but I don't know what it's going to look like. Can a person on H-1B invest with you? Yes, you can. As long as you have a social security number and you file taxes in the US, you don't need an LLC to set up or anything. You can individually invest as an individual investor. Buying a new house or old house is best first time buyer in this market. Depends on where you're buying, what you're buying, look, sub-market. I'm happy to talk to you offline. I'm also a realtor, so if you're looking in the Austin and surrounding markets, I'm happy to help you. I work a lot with investors, and I do the cash flow analysis for them. So how many times in the business have we sold apartment complex, exit, and what's been the minimum value add? We actually have not sold any of our apartments. We're holding through because I started investing 2017, so none of them have hit the 5-year mark yet. I am in a couple of apartments that are getting sold right now. We haven't made the money yet, so I don't know what the numbers will look like. My question is, what's the bottom line annual return in the best and worst case? Maybe take this offline. Do we need to know where you invest and manage? Can we invest cash instead of 401k? Yes, you can invest cash. You can get 100k example, get return 7% deposited every month. What's the guarantee that the capital is not diminished, and what point we can take it out anytime? You can't take it out until the property is sold. So let's take the 100k investment. So 7% is $7,000 a year, not a month, right? And we don't do monthly deposits. We do quarterly. So let's take 8% just for ease of calculation. That's 4 quarters in a year. So we deposit 2% every quarter into your bank, which is $2,000 every quarter for a $100,000 investment. How easy or is it difficult to sell the apartment complex? Right now, probably not that easy, but depending on when we're selling it, it might be very easy. I mean, just 2 months ago, before all this, there was no problems. I mean, you could get 10 offers on an apartment. I think you'll have to ask me your question's breaking up because other people are typing in, although you can't see it. Please ask me a long question in one sentence. Can you please project previous project return for 5 years? So we do anywhere from 75 to 100% returns. So essentially 100, let's say I put in $100,000, you could get like 175 to 200,000 total returns, right? So 75,000 to 100,000 over 5 years. What happens if your credit is bad? Both for investment and buying a house, your credit has absolutely no impact here. That's another advantage. Nobody's pulling up a passive investor credit report, so your credit doesn't matter. As long as you want to invest, you can be, even in India, you can be out of state. You don't even need to be in the country to invest into this. You just set up an LLC here if you're outside the country, and you can invest. When you're buying a house, your credit is bad, it's going to affect your mortgage rates. We don't plan to invest in Kansas right now. Is it income taxable added to regular income? No, it's not. It gets reported just like rental income, your distributions. So it's not taxable like your regular income because you'll have so much depreciation that you can offset it. So let's say I put in $100,000 and I made $8,000 a year. I collect over $50,000 in depreciation. So that means that I can basically get 8,000 times 5. $40,000. Let's say for 5 years, I get $8,000 each year. Then basically up to $40,000 you can write off. So it basically becomes like a tax-free income. If it's 8% annually, how will it be 75%? It's because the 8% is just the cash returns, and then you have the equity return. So let's say it's 8% for 5 years, and the remaining 35% of it comes from the sale of the property. We realized the forced appreciation, the equity gains. So it's the returns are a factor of both. So like we saw here, there is two factors to the total return. There is the cash on cash factor and the equity factor. So the 8% annual, the 7 to 8% annual is just the cash returns, and then we have the equity returns. I think I got all the questions. Any other questions that I didn't answer? It's 9:26, and I think it's yes, the percentage return. Can the percentage return change during the duration of the investment? Yes. So we promise an 8% total preferred return. It's possible that we might not make 8%. It's possible that we might make 10%. So we have usually a split. So generally we'll do 8% preferred and a 70-30 split afterwards. So let's say I make 10% in 1 year, then you get the first 8%, you as in the investors, and then the remaining 3% is split 70-30. So 70% of it goes to the investors and 30% comes to the sponsors. So you can make more than 80, more than 8, and you can make less than 8 as well. So let's say my apartment this year is not doing so well. It's possible that you might make less than 8, but if when we do a preferred, we try to play catch up, which means next year you might make 9 instead of 8. If we haven't done, let's say we haven't done a return 2% catch up this year, we might put it next year. Sometimes it's possible it might take more than 1 year to catch up, depending on what's going on with the economy. So this is like everything else. It's not a guaranteed 8%. It's a preferred 8%, which means you get the preference. If the property is making money, you get it. How can I build wealth? I don't know. That's a very big question. I think we're all here to learn how to do that. Okay.
Thanks, Kavitaji. Thanks for
Thank
taking
you so
time.
much.
We'll have more sessions in future with more opportunities and more concepts.
Yeah.
Thanks, everyone. Thanks for joining tonight, and have a nice rest of the day.
Thank you, everyone.
Yeah.
Thank you, Kishore.
Yeah. Thank you. Bye.
Bye now.